Hi everyone, my name is Mary Redmond and I'm talking about the US dollar Japanese yen right now. And this is an interesting pair. It can be a very tricky pair because it often has its own trading pattern. It doesn't always make sense when you compare it to the fundamentals. And since the dollar and the yen are also both used as funding currencies for the carry trade, it's not as easy to gauge the US dollar Japanese yen in terms of risk appetite, because a lot of these pairs, like the Australian dollar US dollar or the Australian dollar Japanese yen, will go up when people are looking for yield, or they want to earn the carry interest and they're not as concerned about risk in the market. So since they both have relatively low interest rates, they're the two lowest yielding currencies, and they're both used as funding currencies, it can be very difficult to determine which one of these currencies is going to be viewed as safer by the market. But what generally happens is the market responds more, at least it has responded lately, to economic growth in the two countries. So if you see a US economic report coming out stronger than expected, then the dollar yen will rally, and vice versa. And what could be happening now, if you look on a monthly chart, we had this tweezer stick when the central banks were intervening, and we had another tweezer candlestick here. Those are generally the signs that important bottoms have been formed. And it looks like this could be, there was a breakout today out of a tight wedge pattern, a breakout to the upside. And some analysts might have been thinking that there had to be a specific reason for this, but it may just simply be an anticipation of what could be a very weak Japanese gross domestic product number that's supposed to be reported tomorrow. And the Japanese economy has really been suffering since they were very hard hit by those earthquakes, and that stopped production at several of their factories. It's caused the government to devote a lot of its resources to helping people who have lost their homes, and also to try to cool down the nuclear power plants and rebuild in the area. So it's really put a drag on economic growth, and it may continue to put a drag on economic growth in that region for months or years to come. So the markets could simply be responding to better growth and the anticipation that the US Fed will raise rates before the Bank of Japan. And I don't think very many analysts would doubt that the Bank of Japan is just unlikely to raise rates in the foreseeable future. Whereas the US dollar consumer price index came in slightly above the what it's supposed to be in terms of the acceptable growth rate. So if the US CPI was 3.2%, then there's a possibility that they may hike rates towards the end of 2011 or the beginning of 2012. And plus, the market participants, the institutions, could be looking ahead and saying that the interest rates and the Treasury yield have been lowered because of the Fed's quantitative easing program, which is exactly what they wanted to accomplish. And now that that's going to be winding down or ending in June, then the most likely realistic scenario is that the interest rates and the Treasury yields are going to start to go up. So this pair responds very closely to the 10 and the 30-year yield in the US Treasuries. And what you can see, you can actually look at a chart sometimes on a day-by-day basis. It responds very closely. But it doesn't look like we're in an upward trend yet on the yield. But what it does look like is that we may have, just in the last couple of days, kind of formed a temporary base. And this is a pretty low level for the 10-year. So if you look at this particular pattern and we see any type of strength at all in this, it could lead to a really strong breakout in the US dollar Japanese yen pair. And right now it looks like after it broke out of there, you can zoom into 4-hour chart, and it looks like this could be what could be the beginning of a bull flag. And if it breaks out, the probability is higher that it will break out to the upside. And you also have, you can't really say that it's in a full upward trend now. I don't think that we've seen all of the indicators that usually lead to an upward trend happen yet. But you do see the beginning of, what could be a trend change that would be really a long-term trend change, because this pair has been in decade-long downward trend. And fundamentally, the U.S. economy is starting to grow and recover and generate jobs. And fundamentally, the Japanese economy may be going into what could be an even more prolonged slump or downturn. So the fundamentals look better right now for the U.S. dollar than the yen. And what I'd really like to see, if you can see this 8-day ARSI cross the 23-day to the upside, that could be a strong buy signal there. And it looks like we did see that on the 8-hour chart. We haven't really seen that on the daily chart yet. But a realistic possibility for a dollar-yen trade would be to look at it on a daily chart. A good stop here would be below 79.50, and that would give, if it broke below there again, then it probably could go to multi-year lows again. But the risk-reward ratio is pretty good on this trade to the upside, because the downside looks as if it's going to be fairly limited, and there's always a possibility that the Bank of Japan would intervene in the market again. They've made it pretty clear that they don't want the yen to get strong. So if you look at a pullback at this level, and you look at the pattern of the pair, it seems to be winding around this level of a pullback possibly to the 81.40, 81.30 level, with a stop below 79.50 could give a pretty good risk-reward ratio for the this particular pair.